Oh boy, this is going to be so much fun because we're ready to discuss stocks. Exciting stocks, sexy stocks, risky stocks. Yeah. Let's take a look at slide number 1. A popular email that circulated around the internet in 2002 went something like this. If you had invested $1,000 in Nortel Networks stock last year, you would have $50, 95% down in 1 year. On the other hand, if you had purchased $1,000 of Budweiser beer, drank the beer, and returned the cans, you'd have $78. So our stock tip for today is to start drinking heavily. In 2009, this same email was circulating, but it wasn't Nortel Networks. They were already gone. They used to be called Northern Telecom. They were replaced by AIG and Citigroup and Washington Mutual, WAMU and Wachovia and Lehman Brothers and lots of other financial companies that were destroyed by the great financial crisis, the global financial crisis, the Great Recession. And so now probably this email is circulating around, not quite, they're not down 90%, but companies like Facebook, which is I think now called Meta, Nvidia, and Netflix, they've all dropped precipitously. And as we see, history doesn't necessarily repeat itself, but it rhymes. Yes, we're going to see that in stocks, it's boom and then bust, and then boom and then bust, and somehow we just keep going. Somehow, some of us say, no more, no mas, no mas, yeah, my boy. Slide number 2. What is investing in stocks? Well, stocks is such an unfortunate word. I wish they didn't use this word. A better word is companies or businesses. You're investing in a business because when you buy a stock, it actually represents ownership in a particular type of business legal structure called a corporation. We're not going to discuss all that stuff. Take Business 140 business law and you'll learn all about that stuff. Stocks are equity financing, which means ownership. Equity is a fancy word for ownership, right? You are part owners of the corporation. Now you have a little teeny when you buy one share, but still, if you buy one share of FedEx, when that FedEx truck drives by, that one lug nut on the left front wheel, that's your. Bonds, which we'll discuss in our next chapter, are debt financing. You're actually lending your money to the entity that is where the investment is, that issues the bonds. Whereas stocks, you're part owner. Now, why would a corporation issue stocks? Well, there's various reasons to raise money, to start or expand a business, to help pay for ongoing business expenses. This is very typical here in San Diego with the biotech companies that have one round of equity, one round of stocks, and then another round because it's going to cost $500 million to hopefully get that drug to market, as a way to gain prestige and respect within the industrial community. Once you are large enough, it's just expected that you're going to go public. And this is something that was interesting, almost 20 years ago when Google was making money hand over fist. And they thought, well, maybe we don't want to go public. Well, guess what? The boys and girls from Wall Street came knocking on their door and told them about the untold riches that they were going to make. Right, exactly. It's a method of payment for those who started the firm. And if you get the entrepreneurial bug and think, I'm going to create a business and then eventually take it public, well, good luck. Because for every one Google, there is a dozen, Yahoo, which is still around sort of, but nothing like it used to be, and Go, Ask Jeeves, Lycos, Alta Vista, Dogpile. You've never heard of any of those because they're all gone, except for Yahoo, which has changed. It's not really a search engine anymore. So Once you take your company public, you can become an instant multi-millionaire, now billionaire. When Facebook went public, the owner had to pay $1 billion in taxes. Just $1 billion in taxes to the state of California. And once the corporation goes public, they don't have to repay the money. They don't have to turn around and give you your money back. You have to take those shares and sell them to somebody else. But now the corporation is a public entity, and as such has responsibilities and things that they have to do that an individual private business just doesn't have to do. I mean, if you go knock on the door of your local pizza shop and say, "How much money did you make last year?" They'll say, "Who are you? Are you from the IRS?" No, we're not telling you that. But publicly traded corporations must release their data every 3 months. Yeah, it's a very big responsibility. Very expensive, by the way. Slide number 3. Why do individuals purchase stock? Well, you want to share in the success of the corporation. What is the business? What are they trying to do? They're trying to make money, right? And you want to share in that success. And one of the cool things that we don't talk about stocks that you learn about in a business math class is you are a limited liability partner, which means you are only on the hook for the money you invested. If you bought one share at $100 and the company goes bankrupt, doesn't matter what their debts are, you lose your $100. They can't come back and knock on your door and say, you owe us another $100. No. Now, if you are a sole proprietor or in a partnership, yeah, they can. So you have to, you might want to take business law and learn about these things. But what are other benefits? Well, dividends. Yeah, dividends. Dividends don't lie. You could think of dividends like interest payments that you get from your savings account or a bond, which we'll talk about next week. But no, they are distributions of earnings. And those of you who have taken accounting, you probably learned how to do this and said, "I'll never do it again." Or maybe it piqued your interest because there's a whole other world out there that just takes care of the corporate responsibilities. But what most people think about when they think about stocks is the dollar appreciation, the capital gains, the capital appreciation. You want the stock value to go up. Well, if the company does well, that's what should happen. Is it a guarantee? No. Are dividends a guarantee? No, they're optional. Dividends are optional. Capital appreciation is optional. In fact, you could have capital losses. $1,000 can be now $50. Yeah. And our total return is equal to our dividends and capital gains. And as I said, many people key on the capital gains, but dividends don't lie. That's money in your pocket. They used to send you a check. They don't do that anymore. It's all electronic. And then some people, they think about the increased value from stock splits. Well, folks, there's no increased value from stock splits. Don't anybody tell you that. If you had one share at $100, now you have 2 shares. Yippee! But the price dropped in half to $50. The value is still the same. It is a psychological increase at best. Now, some companies nowadays, what they'll do, there used to be a technological reason why they split the stock, but that's gone. What they'll do is they'll split the stock when they're trying to tell the world that, we think things are doing pretty darn good, pretty darn well. We're going to split our stock. Now, they're not going to say that. They're not going to say, "Well, we think things are going well," because if they don't, they can get sued. That's the litigious society that we live in. Warren Buffett, the famed investor of Berkshire Hathaway, has refused to split his stock since its inception back in the 1960s. A single share now goes for over $400,000. Well, yeah, if you had bought one share of Coca-Cola 100 years ago or Procter & Gamble or one of these other companies that have been around for a million years, that's how much one share would be. That's how much our economy has expanded and businesses have expanded. Now, some companies, you bought one share and it's worthless. That's capitalism, isn't it? Yes. Also, what are historical returns? What can we reasonably expect from stocks? Well, stocks have returned 8, 9, 10%. Some have done better. Some have done a whole lot worse. And so actually the stock market as a whole has done actually better than 10% over the last 100 years. But I tell people we can reasonably expect 8, 9, 10%. But do we expect 8, 9, 10% in any one year? No, 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 no. Could be 22% up, 17% down, 4% up, 5%, 12. It's all over the map. The variance, for those of you who are interested in statistics, is quite large. And stockholders used to expect 4 to 6% in dividends each year. That was as much or often more than bonds returned in interest, and stocks were considered much riskier than bonds. In the 1980s and 1990s, and other times, 1920s, but in the late 1960s, but in recent history, in the 1980s and 1990s, dividends fell to less than 2%. And then at the peak of the dot-com bubble, as it's called, the internet bubble, in March of 2000, they hit 1%. Because why? Capital gains were what people wanted. Well, dividends are making a comeback. They're a little under 2%, but some companies are paying far more. Because the dividends are under 2%, this has led some experts in the industry to claim that we're in a stock market bubble, but savings accounts are paying less than 0.5%, right? And bonds were paying less than 2%, but now they've gone up. And some companies are paying more than 2, 3, 4%. A lot of the companies that don't pay any dividends are growth companies, and they have made up a much bigger percentage of the total stock market. So that's one of the reasons that dividends have been depressed on an aggregate basis. But on an individual basis, some companies have been paying very healthy dividends and continue to do so. So don't forget dividends. Dividends don't lie. How do you know? All the other numbers they give you, you don't know if they're true or not. I mean, they probably are, but you know the dividend is true because you got paid. You got money in your pocket. Well, actually, they send it to your brokerage account. Whatever. If stocks are the best long-term financial investment, Payano, how come they're considered so risky? Well, it's very, as Warren Buffett likes to say, investing is simple, but it ain't easy because of emotions. Intellectually, we might know that stocks are the best long-term financial investment, but when you lose 20, 30%, when your $1,000 becomes $600 or your $10,000 becomes $7,000, oh boy, it sure don't feel good. And that's when people panic, and that's the worst time. In fact, that's the time you're supposed to buy, when the market's down, right? That's very difficult. For 2 decades after the crash of 1929, stocks were regarded as gambling by a majority of the population. This impression wasn't fully revised until the late 1960s, when stocks once again were embraced as investments. But in an overvalued market, that made most stocks very risky. Historically, stocks are embraced as investments and dismissed as gambles in routine and circular fashion, and usually at the wrong times. Stocks are most likely to be accepted as prudent at the moment they are not. Now, this is from Peter Lynch, one of the best investors in the world in history, and he wrote a wonderful book called One Up on Wall Street, and you're going to read it because it's, especially if you're interested in stocks, and especially if you take Business 121, Introduction to Investments, because the guy really lays it out on the line why it's a good idea to invest in stocks and what are the pitfalls and where we have to learn to temper our emotions. He called it the cocktail party theory, and it's just so beautiful. He would go to a cocktail party, and people would talk. What are you? Oh, I'm a doctor. What are you? I'm a money market, mutual fund manager. I'm a money manager. I'm an investment manager. And everybody would walk away from him. He said, oh, it's a good time to invest. Nobody wants to talk about investments. And then you go to a cocktail party, and what are you? I'm an architect. Oh, I'm an investment manager and a mutual fund. Oh, really? Do you have any companies that you're investing in? And then Peter would say, okay, the market is probably fairly valued. And then when you go to a cocktail party, and who are you? I'm a lawyer, yes. And what are you? I'm a money manager at a mutual fund. Oh, really? Well, let me tell you about this company I just bought. I don't know the name, but I know the ticker symbol. And I was told that it would double in 3. Yeah, right. That's when he knew. When people were giving the investment manager tips, then he knew, okay, the market's going to crash. And of course it would crash. And then people would all go away from him. And he thought, okay, now it's time to buy again. It's a cycle. In fact, let's take a look at rolling 10-year periods. Dear students, this is such a cool graph. Now, what is this? Okay, let's see if I can explain it. These are 10-year returns from 1928 to 1937, 1929 to 1938, and so forth and so on. And they start right before the Great Depression. And you see, right in the Great Depression, there were rolling 10-year periods where you lost money. You put in $100 or $1,000 or $10,000, whatever. In the next 10 years, you were down. But then we started coming out of the Great Depression, notice a jump here, a bump downward for World War II. Coming out of World War II, the 1950s, the go-go years, science and technology, and look, the stock market went in two directions, up and way up. And what did you hear people say here after 10-year periods where the stock market almost reduced 20% a year? Ooh, is it too late to get in? When you hear people say, is it too late to get in? Yes, the answer is yes, it's too late to get in. Because then we had Vietnam and the turbulent 1960s with civil rights and women's rights and gay rights, and then sex and the countercultural, sex and drugs and rock and roll, and then Watergate and the first gas crisis, and you saw the stock market almost do a negative 10-year return. And what did you hear people say here? Ooh, is it too late to get out? It's the emotions. We're not rational individuals. When you hear people say that, is it too late to get out? Yes, it means it's too late to get out. And what was the real reason for the difficult economic issues in the 1970s? Well, first of all, as Peter Lynch said, stocks were very richly valued after the 1950s and 60s because they had done so well. But more importantly, it was the baby boom generation, my generation, which is now getting ready to exit the... well, not quite. We got some time left, yeah. The baby boom generation coming of age and all going out and needing shoes and houses and cars and refrigerators and jobs, and it was a very difficult time for the economy. But sure enough, it's like a cycle. It is. I mean, it is a cycle. History doesn't repeat itself, but it rhymes, and we start coming out of the 1970s malaise with computer technology and globalization and telecommunications, modern technology that's going to change the world. And of course it has internet, and the stock market went in two directions, up and way up. And then you heard people say the same thing. Oh, is it too late to get in? Yeah, because then we had the internet bubble bursting, the house bubble bursting, and you have to go back to the Great Depression to see negative 10-year returns. And that was the Great Recession or the global financial crisis or whatever you want to call it. And you know what I'm going to say, right? Oh, is it too late to get out? Yeah, it's too late. Now's the time to be buying. And look what it's doing. Now, wait a minute. Does it mean it's going to do exactly the same cycle we've seen in the past? No. But I'm very optimistic. Personally, economically, I think the next 20 years are going to be the most prosperous years in the history of the world, providing we don't blow ourselves up, die in our own waste, earthquake, tsunami, meteorite, disco returning. Yeah. Well, politically, I'm very worried about the rise in authoritarianism, the fact that people are believing things that are totally not true, like elections that have been stolen, even though they were the 2020 election was the most cleanest election in the history of the United States. Why? Because they knew everybody was breathing down their necks. They knew people were already before the election claiming fraud, so they made it as squeaky clean as possible. And yet there's still a big percentage of the population saying that it's a falsehood, and that's dangerous, very dangerous for democracy, because then the other side can say, well, we don't believe you guys won. You see, then it can just fall apart. And the same thing is happening outside the United States. The rise of authoritarianism in other parts of the world, in Brazil, in Eastern Europe, in Russia, in China, and it's scary. But economically, I'm excited. So let's hope for the best, huh? You pays your money, you takes your chances, but I'm very optimistic. I'm still very much invested in the stock market. Now I've become more conservative, not politically, but financially, because I'm old. But I still have a lot of stocks. I have probably more than I should. Okay. Slide number 7. What are the risks? Okay, we talked about the good things. Let's talk about the risk. Well, the company could fail. They often do, not all, but some do, never to be heard from again. The market as a whole could plummet. No, it will plummet. And you know it's going to happen. You just don't know when. People say, Frank, they think I know. They think I know. Are we going to have a crash? I say, yeah. Whoa, what should we do? What should we do? I say, nothing. What do you want? We don't know. We know there's going to be a crash. We just don't know when. Now, when you invest in companies outside the United States, there's what's called foreign risk. And it's a little subtle, and you would learn more about it in an economics class. But the reason that we always considered foreign, or sometimes called international investments, as more risky is just because other companies did not have the same standards of accounting as the United States. But that's all changed. Many countries have better, they've learned from us, and they have better accounting standards. We still have very good standards, don't get me wrong. But so that's changed. That's not as big an issue as it used to be in the past. But now the problem is the currency risk. And this is something that's very subtle. If the dollar gets stronger, if you've made an investment outside the United States and the dollar gets stronger, without any other thing changing, all other things being equal, and of course they never are, all other things are never equal, but your investment will go down. It's like a seesaw. Your dollar goes up, your investment outside the United States goes down. The dollar goes down, your investment outside the United States goes up. And so you have to decide whether the U.S. currency is going to be stronger or weaker over the next 10 to 20 years. I believe it's going to weaken slowly. It's very strong now, so I don't know if I'm right or not. I've been expecting it to moderate because it's been strong for quite some time. And then liquidity risks. And we talked a little bit about liquidity. We'll discuss it again. It means the ability to sell your investment once you've owned it. And it's a big problem with real estate and other types of hard investments like art and collectibles. But it's not a problem with stocks. Unless you get suckered into these penny stocks, stay away from penny stocks. I don't care what anybody says. They are not real companies. They are typically scams. I don't know if you saw The Wolf of Wall Street or one of the other companies like, movies like Boiler Room. They're selling you garbage. And once you are stuck with it, you have a hard time getting rid of it. Yes, so... But that's not, you buy a bona fide, which is a fancy word of saying a real company that's making money. No, it's normally not an issue. Okay, so let's continue here. How can we reduce the risk of stocks? Well, risk is difficult to measure. It's even more difficult to anticipate. It's easy to measure how well you did. How much did you start with? How much did you end with? How long did it take you? But risk, how do you know? You don't. And you do know there's going to be times when stocks are going to fall precipitously. You just don't know when. But emphasizing large company stocks which pay consistently rising dividends has been one of the best strategies for reducing risk. And then another major strategy is simply diversifying. Don't put all your eggs in one basket. And for an individual, this is a little difficult just because of the time constraint and how much money they have. But if you're going to do individuals, it's typical to have people have between 10 and 20 stocks. There are thousands of companies out there, oh my goodness. But this one group, betterinvesting.org, which is an awesome group, by the way, they have this 5-stock rule of thumb. You buy 5 stocks. 1 will do poorly and make you sad. 3 will do about average, they'll follow the market up and down. And then 1 will explode. And that's been my experience. You buy 5 stocks, 3 do okay. Hey, they did all right. One did poorly. Oh well, get rid of that puppy. And then one did really well. Oh my goodness. And you think you're a genius, right? But remember, no, there was just 1 out of 5. So if you buy 10 stocks, you expect it to be, double that. And the most important, in my humble opinion, is simply time. Because over time, the economy, corporations, our standard of living, stocks have done very, very well. Now, if the world ends and there's no food at the grocery store, no gas at the gas station, no clothes at the mall, the cell phones aren't working, the utility companies aren't pumping out electricity or gas or whatever, and the cell phones aren't working, the trash isn't being picked up, the sewage is backed up, the hospitals, the schools, the banks, the fire departments, the police stations are all boarded. Your stock portfolio will be the last thing on your mind. You'll be digging for beetle grubs and boiling bark for dinner. We like to think of ourselves as, independent, and no. We live in this incredibly complex, highly interdependent world. And if you really do believe the whole thing's going to fall apart, get out of the Northern Hemisphere, go down to Tierra del Fuego or Tasmania and learn how to raise goats and sorghum and wheat, and I wish you a lot of luck. Failure is not an option. As I said, I'm very, very optimistic about the world economy over the next 10, 20, 30 years. I'm more worried about political issues, which we could blow ourselves up, folks. Oh, well. Scams. It certainly hasn't helped the cause of stock investing that there are many, many scams out there ready to take your money. One of the oldest and still most prevalent is called pump and dump. The scam artists pump up the price of the stock, from rumors and lies, innuendos. They used to call people. And now they just do spam email. They just spam it. They go on Reddit and talk about how wonderful this stock is and it's a piece of garbage. The buzz dries up the stock price. The scammers dump their shares at a large profit. The price plummets when the suckers realize they have been taken. Now, this is almost always done with penny stocks. And I told you, stay away from them. But recently, because of Reddit and the ability to contact millions of people through the internet in a very unregulated system, we were able, I wasn't part of it, but individuals were able to pump up the price of companies that really were not worth what the price. You might have heard of them, the meme stocks they were called, MEME, like AMC and GameStop. And, I'm not trying to badmouth these companies. They hit on really hard times for various reasons, mostly the pandemic. But the scammers really made out like bandits. They pumped up the price and then sold, and then the price plummeted. But because of the nature of the internet, they were able to do this over and over again. Just unbelievable. And the SEC, see, they're always on the lookout for a group of people, 5 or 10 people doing this. But when 8 million people are involved, what is the Securities and Exchange Commission going to do? Shut down Reddit? No, it'll just start up somewhere else. So it's a real problem. It's a real problem. So stay away from scam stocks. Look at companies that are real companies, and you know them when you see them. Some of them you maybe never even heard of, but then when you do research, you realize, oh my goodness, this is a very big company. Now, it doesn't do business with the public, it does business with other companies, but it's a real company. So that's the cool thing about stocks. There's no end to how much you can learn, dear students. Bubbles, manias. Occasionally, investors get caught up in what are called stock market bubbles. Manias. Ooh, is it too late to get in? The dot-com bubble was the latest stock market mania. Now, many people talk about the what's happening now with the FANGs, they were called: Facebook, Amazon, Apple, Netflix, Google, and these were companies, and don't get me wrong, they're very good companies. I'm not a big fan of Facebook, but these companies are producing a lot of income, and they were growing at a tremendous rate. Well, many people say we're in a bubble like that with companies like NVIDIA and Roblox and Stitch Fix and all these internet-based things that are going to change the world. And some of them have, and some of them haven't done as well. Now, the 2008 bubble was not a stock market bubble, folks. It was actually a real estate bubble, specifically the bonds that were based on the real estate. And we'll discuss that in the next chapter. So don't blame the stock market for the 2008 Great Recession. But before that, there was the Nifty 50 of the early 1970s. These were companies that no matter what, you are going to do well. Companies like Avon, which, I think is still around, but Xerox, Polaroid, which is, the name is still around, but the company's been gone for decades. I would never want to invest in a company whose name rhymes with hemorrhoid. I just don't think it's a good idea. The bubble of the 1920s caused the crash of 1929. You ever hear of Radio Corporation of America? Yes, you had. Yes, you have. It's RCA. It was selling for over $110, and then 4 years later, it was selling for $2. Yeah. In the 1840s, there were 400 railroad firms. There are less than 5 now. The granddaddy of all bubbles was the Dutch tulip bulb craze of the early 1600s. You heard that right? Tulip bulbs were sold like stocks. Now, there's some, controversy over how bad it really was, but it was not good. People lost fortunes. And each time the phrase was, it's a new era. It's different this time. The old ways of valuing stock are gone. And when you hear people say these things and say, is it too late to get? Yeah, it's just don't sell. Don't run for the hills, but just especially if you're younger. If you're older, then you got to, diversify away from stocks. Keep a little bit of stocks depending on your age. But yeah, it's time to run. Okay. Now, what about taxes? You only got to talk about taxes, right? Well, there's not much to say other than the Congress wants you to invest in stocks, because if you hold the stocks for more than a year, you are richly rewarded in how much taxes they will take. If you don't hold them for a year, and this is why the day trading or month trading or whatever, trading stocks quick is really not a very good idea from a tax standpoint. You're taxed at your individual marginal tax rate. Remember that from chapter 3? I told you we're going to come back to that. So you don't want to hold stocks for less than a year. Now, if you make a mistake, okay, or if somehow it explodes on the upside and you think, wow, now this is really overpriced, okay, you're going to take your gains. But you want to hold the stock for at least a year. In fact, Warren Buffett says hold it forever. Hold it for a long term, 5, 10, more years, because it's a business. And dividends were traditionally taxed as income at your marginal tax rate, but now the Republicans have made sure that they're taxed at the same low rate as long-term capital gains. This has been a huge windfall for the very wealthy, and something that's good for us, little folk too, if we are so inclined to invest in dividend-producing companies, which I am, because what do we say about dividends? Dividends don't lie. Now, where do you house your stocks? Well, there are 3 groups. Actually, there's now kind of 2 groups. The full-service brokers like the Merrill Lynch's and the Morgan Stupens. I'm sorry, Merrill Lynch and Morgan Stanley. Actually, I don't think it's called Merrill Lynch anymore. I think it's called Merrill Edge. And they'll give you a individual who will take you to the steakhouse. They want you to have at least 100,000, 500,000, a whole lot of money, and take you golfing and make you feel good. And then there's the discount brokers, but they've basically all become deep discount brokers. Using the internet to really reduce costs. You don't get anybody to help you. Some offer free trades. Ha ha ha! They're not free, folks. No, they're not free at all. You're not paying a commission. You're not paying a commission, but you're getting charged. And if you really want to learn how to do that, how they do that, contact me, or better yet, take BUS121 Introduction to Investments, and we go into what's called the spread, the difference between what you pay and what you get when you sell. And that's, if you ever go down to Tijuana or San Isidro, you know that there are 2 numbers. How much you pay how much you get when you give your dollar and get pesos, and how much you have to pay with pesos to get your dollars. There are some other low-cost options. We talked about Better Investing. They really push this idea of using dividend reinvestment plans, and they have this wonderful name, DRIP. Do you want a drip? Yeah, I like drips. And again, we would learn more about these in the Introduction to Investments class. And then originally people used paper, right? It wasn't electronic. It was all paper certificates. Now they are unheard of. Don't ask your broker for a certificate because nobody wants you to have them, and they're a real pain in the patootie. But some people buy old certificates, and they've become sort of a what's the word? They become a collectible. These old certificates, and so check on the website. I'm not going to stop. In the face-to-face class, we would show them now, but check them out. Especially the Disney. They got so popular that Disney said, no more. We're not going to issue any more stock certificates because they're very colorful and they got all the Disney characters. So people would buy one share of Disney just so they could have a stock certificate to hang on the wall. Right. Yeah, that's people collect things. Okay, slide number 13. Now, take a little break, stretch, okay, because we're going to discuss the different classifications of stock investments. Because, see, people have this tendency to think that all stocks are the same, right? They're all the same. Look at the stock market. We talk about the stock market as if it was one big, which it is. I mean, in the aggregate, it's tens of thousands of companies. But no, companies are all different. Now, some fit into certain categories. Some fit into more than one category. Some don't fit into any category. So it's a little strange. But let's take a look at these. And I want you to study these. Just what you see on the presentation is all you need to know. Don't worry about, being perfect. If you have to, stop, get a notepad and write these down. Of course, they're on the study guide. The safest and most respected and strongest companies are called blue chips. Huh? Blue chips. It actually comes from gambling. Over 100 years ago, 200 years ago, only gentlemen owned stocks. First of all, women, I think they could own them, but they had to have a man sign for them or something. And certainly the little folk didn't own stocks. Gentlemen owned stocks, and gentlemen gambled. That's what a gentleman did. They also got rip-roaring drunk and smoked cigars and brandy. And so the blue chips were the most expensive chips on the gambling table. I don't think that's true anymore, but that's where the name came from. And this refers to conservative investments. And now we're not talking about politics, folks. We're talking about people who want to invest in stocks but don't want to lose a lot of money. And so AT&T, Coca-Cola, General Electric, Walmart, Nike, companies that have their roots deep in the economy, ExxonMobil, right? And so they are often referred to as value stocks, but you got to be careful because value means something else a little different in the industry. We learn more about that in 123. Then there are companies that pay higher than average dividends, like utilities and banks. Why? Because utilities aren't growing very fast, right? But people don't want to take cold showers in the dark, right? So they're going to want their energy. And utility companies then pay good dividends. Same thing is true for banks. Well, for decades, banks were really good income stocks. Then they started to get real exciting, and that's when they made a lot of stupid mistakes in the 2000s and almost brought down the entire economy, and now they're boring again. Hooray! We just love boring banks. I do anyway. So those are income stocks that you buy for the income, for the dividends. Now, sometimes a blue chip stock will be an income stock, you see? So they can sometimes fit in two categories, but sometimes not, growth stocks. These are the stocks that are on the cover of Vogue and GQ and Vanity Unfair. They've got beautiful teeth and gorgeous hair and six-pack pecs, and they'll wear the best clothes. And these are companies that are growing at a rate 15-20% a year or higher, which doesn't sound like much, but folks, the economy grows at 2-3% a year, which is sounds tiny, but when you're a 20 some trillion dollar economy, that's a lot of growth. But when a company is growing at 15-20%, that means in 3 years it's going to be twice as big as it is now. They usually don't pay any dividends, or maybe a small token amount, because the profits are reinvested back into the company. The stock price should go up as the business grows, but will usually be very volatile, and that's exactly what's happened with the FANGs, the Facebooks, the Netflix, and these stocks are very volatile. And so I have down here Intel, HP, and Microsoft as growth stocks. I'm saying, wait a minute. Are Intel, HP, and Microsoft growth stocks anymore? Well, 30 years ago they were when microcomputers were starting to take the world by storm. But now Microsoft has actually been growing their cloud business. But Intel and HP, not so much anymore. No, it's the FANGs. It's the internet service not the internet service company. The internet, I don't know what you call them, social networking. But Google is that's a search engine, and Netflix. It's a streaming service. So these services that are sitting on top of the internet were Amazon were doing all the rage, and now they're hitting on hard times. The stocks, at least. I think some of the companies are going to do fine over the long term, but their prices are very high. They don't really pay very much dividends. They're growth stocks. So you live by growth and go out with the beautiful people, and you then pay the price with a big hangover when the stock gets hammered. Now, on the other side of the coin are cyclical companies. No. These companies follow the business cycles. When the economy's doing well, they do well. When the economy's doing poorly, they do poorly. And the poster child for this are automobiles. When the economy's doing well, people are getting jobs, their pay is going up. What do? Rush out and buy a new car. But the old car, no, I want a new car. I like that new car smell, right? When the economy hits hard times, people are losing their jobs. Do people go out and buy new cars? Not usually. And so you can see the automobile companies do really well when the economy's booming and do really poorly. But they're not the only ones. Any company that makes stuff, materials, timber, steel, chemicals, and now computer chips. Because in everything you buy, there is a computer chip. So as the economy produces more stuff, these companies do well. And as people say, I'm fine, I don't need a new television, these stocks tend to do poorly. The other side of that coin are the defensive stocks, not the defense stocks. They're the companies that make bullets and tanks and stuff like that. We're talking about companies that remain stable during declines in the economy. Food companies, consumer staples, Kellogg's, right? You eat more Cheerios, you eat more cornflakes because the economy's doing well. Do you eat fewer cornflakes, right? No, you eat what you need to eat. And companies that make soap and shaving cream and toothpaste, that's like Procter & Gamble and Colgate. And then drug companies. Well, drug companies are typically defensive, but they also have their own cycle of new drugs and old drugs. But do you take less insulin because the economy is doing poorly? Do you take more insulin because the economy is doing well? No, you take your insulin. So those are defensive stocks. The type of stock that people tend to key on because they're in the news so often are speculative stocks. Speculative stocks. Now, these are either going to do really, really well or they're going to implode. We use the term speculation in the investment industry. When you hear the word speculation, you insert the word gambling. Now, we don't use the word gambling. Oh, that's an ugly word. We use the word speculation. Oh, yes, it's a very speculative issue. Yeah, right. Have you ever heard of GoPro? Their products are still around and they're very cool products, but the stock exploded on the upside when everyone thought everyone was going to go out and buy they're called Heroes, right? GoPro Heroes. Well, it turns out there's a very small market for these things. One of my students kept saying, well, what do you think about GoPro? I said, well, I don't know. I mean, if there's so much of demand, how come Nikon and Canon and Apple, who make cameras, how come these people aren't coming out with their own GoPro type devices. And obviously they had done their market research and realized this is just for a small percentage of the population who jumps out of airplanes and uses motor scooters to jump over big things. And so, yeah, GoPro, went broke. It didn't go broke. It's still around. But when you learn how to research stocks, look up GoPro and see what happened to the stock price. It skyrocketed up and then fell to the earth like a roller coaster. Bluebird Biotechnology. Now, first of all, they don't use uppercase. Now, what's wrong with that? I don't know why. But anyway, this is a company that is doing very, really cool stuff. And hopefully they're going to cure cancer. And it's not working out as well as they thought it would, but soon, but maybe somebody else will beat them to it, and then that's the problem. Twilio or whatever, I gotta look up what they do. And Stitch Fix. This was brought to me by one of the other professors. I said, Stitch Fix. Well, first of all, you gotta know I hate clothes. The only reason I wear them is because if I don't, you go to prison, right? Or it's cold outside. But this is a company that makes clothing, and you take a picture of yourself and send it to them on the internet, and they design it right to your specifications, which I thought was cool, but I don't know. I mean, I don't know. I'm the worst person to ask about retail and sales and fashion and the like. And of course, the stock did really, really well and has imploded on the downside. So unless you like gambling, stay away from speculative stocks. Now, there are a few others that, for the most part, most of us are going to stay away from. Turnaround stocks, companies that have fallen on hard times. You have to ask yourself, is there potential for a rebound? Because usually you can get the price at a very good price, and there's often a reason why, because it's not going to be a turnaround, it's going to be a goner. I usually call them goners. And many of you were not even born yet, but in the 1980s, early 1980s, Chrysler almost disappeared. The stock price went from like 47 down to 3. And then they got a gentleman by the name of Lee Iacocca, who really turned the company around. He did a very good job of turning the company around. And the stock price in a few years later was back up into the 40s. See, you had to have the courage to buy a turnaround stock because usually they don't turn around. And then after the Great Recession, GM, Ford, and Chrysler were like this. They were turnarounds. We thought maybe they're going to disappear, but they all have survived. And so congratulations and many thanks, because they have a lot of jobs there, folks. And they're not, there are companies that supply GM and Ford and Chrysler, and they would have all gone bankrupt. Oh boy, there were some people who said, no, let the companies go bankrupt. They didn't understand how many jobs would have been lost around the country. I'm glad that they did it. Of course, you can't go back and try it and see how things will work. It's the problem with economics. We don't call economics the dismal science for nothing. Now, there are some companies that are called asset plays. These are companies that are sitting on an asset that could be sold or spun off, or maybe that asset underneath them is doing really well. One example of this was JCPenney's. JCPenney's has been around for 120 years, something like that, or more. And they had an insurance division. They had a bunch of other assets. And they were able to sell them to raise cash to keep the company afloat. I don't know how much longer they're going to survive, folks. They're really having a tough time because they're getting hit from the top by the needless markups and the other very expensive places, and from the bottom by the Targets and the Walmarts and the Costcos. So I hope they do well, because I have a soft spot in my heart for JCPenney's. There's a reason why. I'll tell you later. But there's another company that you may have heard of, Pepsi. Pepsi, yeah. Wait a minute. It's a soft drink company, right? Well, I hope I piqued your interest. What major snack food company does Pepsi own? Look it up on the Infernal Net and see what you can find. And then the last category that we'll talk about, which really shouldn't be discussed in polite company, are penny stocks. Folks, stay away from these things. Butterfly.com, Flim Flam Incorporated, they are scams. And if you ever saw The Wolf of Wall Street, and I showed just the parts where they don't have all the sex and drugs and rock and roll, to my students, and it's really amazing how this guy sells these people stocks of companies that are somebody's garage. They're based in somebody's garage in the backyard of their house in Iowa or Idaho or one of those places that starts with the letter I. It's a scam. These are scams. Stay away from them. Okay, so now that we've gone through that, we ask you to determine, hey, now don't worry about being perfect. And there are some stocks that really don't fit in all categories or any categories, and some fit in 2 categories. What would you do with Johnson and Johnson? You know where Johnson and Johnson, what they are? Yeah, baby food. No, I'm sorry, baby powder, Q-tips, Band-Aids. They just have so many products, and they make drugs. One of the COVID vaccines was a Johnson and Johnson vaccine. So they are a blue chip. They've been around for 140 years, something like that. They're also a bit of defensive stock because healthcare tends to be defensive. People need help, they get it, right? It's not like a car where you can say, I got an old car, no problem, keep it. ExxonMobil. All right, another blue chip stock. They also tend to be cyclical. Why? Well, they make stuff. In this case, they make oil and petroleum products. And as the economy does well, they will do well because people will be needing more oil to make their stuff, because oil's in everything, either the manufacturing process or as an ingredient. Amazing. We're based on oil, folks. Google, right, growth stock. They're on the cover of GQ and Vanity Unfair. And but now, right, because the economy is starting to slow, their stock price not as bad as some of the others, not like the Stitch Fixes of the world, but still, it's taking a bit of a hit. But I don't think they're going anywhere, folks. I mean, everybody uses Google. Sempra Energy, that's SDG&E, right? Very income oriented. Utilities are very income oriented. They also tend to be fairly defensive. Why? Because unless they're involved in the manufacturing process, but people don't want to take cold showers in the dark, so it depends on what area the utility services. If there's a lot of manufacturing, then there's going to be less demand for their oil, gas, or whatever they produce, electricity. But in most residential areas, no, it's not going to be a big deal. What does General Mills make? Right, Cheerios and dozens of food products, Wheaties. So they've been a blue chip stock. They've been around for over 100 some odd years. And they're also very defensive because food is very defensive. International Paper. Well, what do you think? They make paper. But when you make paper, you also make timber. It works both ways. And so they make stuff, right? Cyclical. They're also a blue chip. They've been around for over 100 some odd years. Cyclical stock. They also pay not a great dividend, some income, but not a great dividend. But they pay dividends because as people buy more stuff, they need more timber and other wood products. Now, Union Pacific Railroad. One of the last remaining big railroad companies. They are a blue chip stock, right? They've been around for over 170 years, right? But they tend to be cyclical. Why? Because transportation, right? The stuff has got to get to where it's going to be, the raw materials have to get to where they're going to manufacture the stuff, and then the manufactured goods have to get to where they're going to be sold. And so railroads, other transportation companies tend to be cyclical. But what are railroads sitting on that they were given 178, 180 years ago? Land. Railroads own very, very lucrative, very expensive land. A lot of downtown areas. In fact, where they wanted to put the Chargers wanted to put their stadium, it was all owned by the railroad company. So the railroad company's going to say, "Oh, fine, pay us for it." So they're an asset play. Now, General Motors for decades was a blue chip, and then it went bankrupt. And in the mid 2000s, I was looking at the stock saying, this doesn't look good. They're going to lose some money on every car they make. There's no way. They're only making money on SUVs and pickup trucks. They're going to go bankrupt. And now I didn't invest in them. I didn't try to anti-invest in them. There's a way to make money when a company goes down. Stay away from it. It's dangerous. But I was right. They went through bankruptcy. And their CEO kept saying, "That's all this talk about bankruptcy. We don't want to hear this talk anymore." And that's when I knew they were going to go through bankruptcy. So the General Motors of today is not the same General Motors of yesterday. They went through bankruptcy, came out of bankruptcy. They were a turnaround, and they were able to do it. Congratulations to them. And they're actually doing pretty well in China, believe it or not. In China, they're doing pretty darn well. Now, what about Flim Flam Incorporated? Right, penny stock, scam stock, stay away. Yeah, just we shouldn't even talk about these things in polite company. And now, who are General Dynamics? Who or what? Have you ever driven by NASCO down on Harbor Drive? Yeah, General Dynamics bought NASCO, and now the NASCO keeps getting smaller and smaller, and the General Dynamics keeps getting bigger and bigger. They're a defense contractor. They make aircraft carriers and tanks and jet planes and submarines. Where do you put them? Well, they're a blue chip company. They've been around forever. But their income, they pay pretty decent income, not great. Some companies are just very difficult to categorize. In fact, the defense contractors have their own cycle. Doesn't follow the cycle of the economy. It follows geopolitical cycles. And now people are jumping up and down and saying, now's the time to buy defense companies because we're going to go into World War III and they're going to do really, really well. Folks, if we go to World War III, no one's going to do really, really well. We're going to be lucky here in San Diego because we'll get vaporized immediately. And it's attributed to Nikita Khrushchev, who was the Soviet premier during the Cuban Missile Crisis of the early 1960s. He supposedly said, he probably didn't say it, we don't know who said it, the living will envy the dead after a nuclear exchange. And on that happy note, my apologies. On that happy note, we want you to go back, read this over, listen to it again. Stocks are exciting. Stocks are sexy. Stocks are risky. But they're the best financial investment over time, in my humble opinion. And we're going to learn eventually more about them, where they're exchanged, how we measure them, some numerical measurements that we can make, and then start to use our judgment to decide which companies individual we would like. And we're going to find it's not easy to do, folks. If it were easy to do, everybody would be doing it. It ain't easy to do. But luckily, after we're done with all this, we're going to see that we don't have to do it. No, as we discussed in the previous chapter, mutual funds that invest in stocks, let the professionals do it. Now, having said that, some professionals do a very good job. Some don't do a very good job at all. So in our next presentation, as I said, we're going to look at the various places where stocks are traded, the ways we measure the performance of stocks, and the numerical information and numbers about stocks, and then look at some examples of stocks. Cool? Cool. See you in our second presentation, dear students. Thank you so much for being in our class. Think about how much you have learned. You are awesome.